I would hope that, cooler heads will prevail and 1031 will survive. I think the rates may not be as high an increase, that they may negotiate it down somewhere in the middle. I don't think increase to 25% maybe is not the end of the world, and maybe is a fairly good compromise to make it more in line with what income tax rates are.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odum and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odum, along with Steven Silverman. Steven, welcome back from your vacation.
Vacation. So I take off one day and it's a vacation.
Yeah, the vacation is fixing your flat tire.
Yeah. And that's
actually
the
it was the clutch.
Yeah.
That's it.
It's just one.
That's your one day off for the year, Steven. You're done. So, I'm sorry you got stuck on the side of the road in 98-degree heat, but better you than me.
Well, I don't share the sentiment, but thank you. So we've been adding a new property to our property management, and it's been an interesting story because this was somebody who was thinking, should they sell, shouldn't they sell, or should they stay in it for the long haul? And one of the things they've been worrying about is 1031 exchange.
Yeah. As you know, we do property management for investors. I mean, we essentially will help investors buy property, and then we manage on the back end, send them a check. And of course, every couple of years, the subject of 1031 comes up, and we have to be on top of our game because they have questions, and we try to find answers for them about the chances of the 1031 being overturned. Our government has a big problem, Stephen. It's got a fiscal responsibility problem, and they got to figure out how to fix it. It just seems to get worse and worse every year. It doesn't get any better. And so this year, at least, it seems like they're trying to take a crack at addressing the deficit. But 1031 is not the way to do it. There's other ways to go about this, and we're going to talk about this a little bit. We got a great guest. He's a guy who's been on the show before.
Yeah, and he certainly knows everything about 1031 exchanges. You talk about the government addressing the deficit. I think the way we're addressing it is we're creating a bigger one because really, everybody's talking about the 1031 exchanges to get rid of it to help pay for the deficit, but it would be a drop in the ocean.
Yeah. It definitely would be. But the fact is that 1031s are accretive. There's a multiplier effect with 1031 exchanges, and it actually generates revenue and jobs and economic development and everything else. So it's not something you really want to try to kill. If they just be patient, they'll be able to let everybody earn more money and breathe a little bit more on the back end of these deals. Well, enough from us, Stephen. Unless there's something else you want to talk about, let's get going on with our guest.
Today we have with us Michael Brady. Michael is the Executive Vice President for Madison 1031 Exchange, a national qualified intermediary for tax-deferred exchanges pursuant to the Internal Revenue Code. He is a certified exchange specialist, an attorney, and his responsibilities include consulting with clients and their advisors on 1031 exchanges, as well as giving seminars to other attorneys, accountants, and real estate professionals, and publishing articles on tax and legal issues. Michael has over 20 years of experience in representing clients in real estate transactions. Michael, welcome to the Invest Florida Show.
Thank you for having me on. It's great to be here.
Yeah, Michael, you're a retread. We have to tell our listeners that you've been on before talking about 1031s, and you're definitely the go-to person for us. You're one of, if not the most knowledgeable person I know in the 1031 arena. Been doing it for an awful long time, and you and I go back about 15, 16 years now.
I think it is, yeah, probably back to like 2005 or so. It's been a while, so I guess that means we're both old at this point.
Yeah.
Well, I was just going to give you my sympathies for having known Eric for that long, but
See how this works, Michael? So let's go ahead and roll. I mean, there's been some changes, and we've been talking to our people, our clients about the 1031, various stages of panic over what's happening. But for the folks, just for real quick, because most of the listeners that are going to be on the show already know what a 1031 exchange is, why don't you just give a 30-second elevator speech of what it is and why it's important to them?
Yeah, sure. So a 1031 exchange allows real estate investors to defer their capital gains taxes by simply reinvesting their profits from one property into a new property or acquiring a new property. And the thought is that they're just continuing their investment, so why should they be taxed in the middle? They're just going from one property to the other. And what this has allowed people to do is to basically build wealth and in turn improve properties that they've acquired in a way that has really benefited not only real estate investors, their tenants, but the real estate industry and the economy as a whole.
The purchase and sale of real estate, there's a multiplier effect. Everything from carpenters and electricians doing repairs to if you're a business, and being able to use a 1031 exchange allows you to expand your plant and equipment and add jobs. So I mean, it's one of the big drivers of our economy, and certainly it's one of the most important reasons why someone would invest in real estate, because of the nature of the tax deferred status, if you want to be able to engage and do a like-kind exchange. So, Michael, it seems like every couple of years something happens in DC that you get this surge to want to change or eliminate the 1031 exchange. So why don't you give us a little overview of what's going on in DC right now?
Well, just before that, one second, if you could just give like a brief history, because since the time period that you and Eric have been friendly, things have changed. It was up at 20%, then it came down to 15%.
You talking about the capital gains, Stephen?
Yes.
Capital gains.
And, that all has an impact with it, and just how they kind of flows together. So maybe you can just give a quick synopsis of how capital gains and also the 1031 has changed over the last few years.
Sure. And just one thing I wanted to start out saying is that, 1031 exchanges are not some new concept. They're not some mere loophole. The concept of exchanging property has been in the tax code it's just about 100 years now. 1920, I think, is when it was first added to the tax code. So this is something that's kind of part and parcel of our modern tax code. The rates, as you said, have been changed somewhat. The last couple of decades, they've been at historic lows. We had a 15% rate, maximum long-term capital gain rate for many years. That was changed under President Obama. They raised it 5%, the maximum rate, from 15 to 20%. For higher income taxpayers, and they added a 3.8% net investment income tax, which was designed in part to pay for the Obamacare package. So the maximum rate currently stands at 23.8% if you sell investment property. You also have, in many states, you have state income taxes, and in some cities, like New York City, for instance, there's a city income tax as well. So there's been some changes, and they're talking about changes now. There's a push because these rates are far less than what you would see as a maximum rate for income taxes. And there's a thought that under the American Families Plan to kind of change the rates and put them more in line with what our maximum income tax rates are. So that's one of the things that's being considered. And they're talking about limiting the ability to do 1031 exchanges to deferring $500,000 of gain per taxpayer every year. So, I guess the thought is that way you would only impact the so-called higher income or higher wealth taxpayers as opposed to lower. But, in this modern economy with modern real estate values, $500,000 really is not that large of a gain.
Low, yeah.
We see far in excess of that. So it's troubling that that's what they've looked at. And as Eric said before, this is not the first time we've been on the chopping block.
And it's kind of one of these situations with 1031 exchange that there's not seemingly an organized opposition to it. So when politicians are looking for ways to be able to raise taxes, raise funds to be able to pay the expenses that they have every year, it seems like it's an easy target. So it seems like every time that there's some sort of a change in the tax code, it's people want to throw in the 1031 exchange, and it becomes tiresome. And speaking of tiresome, and I think a lot of, listen, we've been spending like drunken sailors and talking about it in the United States now for a while. And we have everybody, I think if you speak to most people, they understand that eventually you've got to try to get some of this under control. And so it's important for people to understand the role of 1031 exchange. The United States is not the only one that has something like this. You see it in Europe. You see it in places that have a lot higher tax code, a lot more aggressive tax code, right, Michael?
Yeah, you do. And, just to back up on that, so this is not even so much a partisan issue, right? So under the discussions for the 2017 Tax Cut and Jobs Act under the Trump administration, there was talk then about completely eliminating 1031 exchanges. And in fact, they did eliminate 1031 exchanges for personal property. So, that was a Republican initiative, and that cut out a good chunk of 1031 exchanges. And now we can only do exchanges on real property. So we cannot do things like, machinery and equipment and aircraft, which we used to do, a fair amount of. So now it's just real property. And, there have been efforts in the past, as I said, to limit it to, I think under Obama, they had discussed $1 million. And, I think the emphasis or the attention on 1031 is misplaced because, first of all, it doesn't generate the revenue that they think it does, because studies have shown, I think, 80% of all tax-deferred exchanges ultimately result in a taxable transaction. So really, it's kicking the can down the road. These taxes are paid ultimately by taxpayers in something like 80-some-odd% of the time. And additionally, the savings is just not that great. Or the tax revenue would not be that great. I mean, they're talking about between, I think, the American Jobs Plan and the American Families Plan, they're talking about $6 trillion of spending. We're talking about with 1031 exchanges, I think the numbers are something like $80 billion based on Congress's numbers. It's a drop in the bucket for what they actually need to fund what their objectives are. And we've already talked about what the cyclical effect of that is. Without 1031 exchanges, which form a good portion of commercial real estate transactions, Eric, you probably see with your clients, they just won't sell. Right? They have to pay taxes, especially if the rate goes up to something like 37%. They're just going to hold on to their properties.
We've discussed this on the podcast, and we've spoken to smart people on both sides, and we have one school that says, well, if the 1031 goes away, then people will be less interested in investing in real estate and prices will drop. And then others are saying, well, people will be less interested in selling their real estate because they don't want to pay the capital gains. Therefore, there'll be less supply and increased demand and prices will go up. And I'm just wondering, in your conversations with some of your clients, what sentiments you're picking up?
Yeah, I think people are just not going to sell, and you'll have less incentive to invest. And I don't know. I'm not sure what will happen to prices. I can tell you already, demand is exceeding supply. I guess that would get worse. I just worry about what comes after that, right? So you don't have real estate transactions regardless of what the prices are. They just won't be transactions. There won't be flow. People will be stuck in their properties, which means, less real estate commissions. There'll be less, title insurance premiums, and sure, that's real estate industry. But what about construction? Most of our clients, when they buy a property, they're investing significant capital to improve it. The value add is really where the money is in real estate. So now they're not hiring contractors. What also people forget is that a lot of our municipalities feed off the real estate economy. They rely on, things like transfer taxes and recording fees and all these other things that come along with the real estate transaction. So it's not just, investors and business owners. It's actually municipalities as well.
Yeah, no doubt there's a multiplier effect. And I think we'd be remiss to not talk about it, at least. It's not just real estate and real estate investors. It's also those businesses that are trying to grow. And one of the drivers behind the 1031 is, look, let's worry about taxing the accretive value that this company is creating by expansion, rather than trying to put additional cash flow restraints on them. That would be a disincentive for them to try to invest. So, in other words, if you have a company that has a 100,000 square foot warehouse and they need to sell and because they want to build and buy a 200,000 square foot warehouse. That's good for everybody. It adds jobs. It adds all the things that you talked about, from the carpenters, the electricians, the title companies, and et cetera, et cetera. And then also the municipality gets an additional 100,000 square feet of property taxes. So everybody wins. And there's really should not be any disincentive to allow that to happen, because, you get more jobs. And, we've talked about it, beating the horse at this point. But we really need to mention this, because it is really important. If you end up with this company that's sat on this warehouse for 20 years and they have significant capital gains, now they not only have to come up with the equity to build and buy their next property, they also have to come up with the equity and the cash to be able to furnish and fit that facility that they're now going into. And then you're going to add another layer of taxes on top of that, of significant capital gains. And now they're looking at it and going, we don't have the cash flow necessary, and it's going to slow and have a dampening effect on economic growth. And so I think it's important that we talk about that too.
Yeah, no, absolutely. It's especially as the economy is coming out of, the pandemic-related recession. We just don't need breaks like this that are, going to hurt a really big segment of the economy. One thing I just wanted to mention, I want to push back on you a little bit about organized opposition. So there is some organized opposition to this, and I just wanted to mention a website that folks can go to that makes it really easy for you to let your member of Congress know that you're against these changes to 1031 exchanges. You can go to 1031taxreform.com. There's a button there to take action. It will bring you'll fill in your address, and it'll tell you who your members of Congress are, but it'll give you a kind of a scripted email that you can send to your members of Congress to let them know that you're opposed to these changes. So that's important. That's 1031taxreform.com.
So just to ask you a really difficult question, do you have any gut feeling as to when this might go down, the timing of any changes? And also, there's big concern with the people that I talk to that perhaps it might even be retroactive. Just wondering what your thoughts are on that.
Yeah, so I think, just to answer your last question first, I would be extremely surprised if it was made retroactive. And I think the administration has put out a publication that indicates that that's not what they're considering. They're looking at 22, so January 1st, 2022, rather than making retroactive. I don't know how you can tell people who have started an exchange in 2021, they've spent all their money buying replacement property, so they have no money left, and now you're going to tell them that they owe taxes. I don't see how that works. The IRS, even in their most evil incarnation, would not do that. But I can't guarantee it, but it seems that does not seem to be the case. What is interesting, I had a conversation with a client just yesterday, is what happens if you start an exchange, though, in November, right? And you don't complete your exchange until, let's say, February, March of 2022. How does that work? That's a question that's open. Again, I think that you still would be grandfathered in. There is some concern that the rates may increase retroactive. They said that the rates could go back to the date of announcement, which for the American Families Plan was April 28th.
Yep.
So they could make the rate retroactive to then. Again, I don't see that happening. If all this goes through, I don't see how you tell people, basically they're not going to pass this probably till, let's say, August, September, maybe, 9 months after the year started, that the rate is different than what they anticipated. So, I'm not so sure I see that either. But I'm actually optimistic that 1031 is going to make it. Maybe it's just I'm getting cocky after having been down this road a couple of times before. But if you look at the political picture, I don't believe that they have the votes to do this. Yes, it would pass under reconciliation, so it would only take a majority. But we're kind of seeing pushback from the kind of center right wing of the Democratic Party, where they seem to be opposed to some of these things. So I'm talking specifically about Manchin and Sinema and some others. And I don't see, Republicans most likely are not going to cross over. So I think, at best, there'll be a compromise package. I would hope that, cooler heads will prevail and 1031 will survive. I think the rates may not be as high an increase, that they may negotiate it down somewhere in the middle. I don't think increase to 25% maybe is not the end of the world, and maybe is a fairly good compromise to make it more in line with what income tax rates are. But that all being said, we have to keep the pressure up, right? And so I urge everybody to really, voice their opinion. Now, our lobby organization, or our trade organization, I should say, the Federation of Exchange Accommodators, has kind of led the charge on this, and the National Association of Realtors and some other organizations, have joined us in that fight as well.
Yeah, and I'm glad you kind of wrapped that up with let's not be complacent about this. And I agree with you. I tend to believe that it's more likely than not that the 1031 piece of the American Family Plan is going to go away. But let's not sleep on it, guys, because this is serious not for our business, but for not just for our business, but also from the investor class and everybody that participates in real estate. So let's not sleep on this thing.
Yeah, for sure. We have to stay diligent. Continue to do what we're doing and, get Congress to listen to us and listen to reason.
So, Michael, if people want to reach you, what's the best way to find you?
Email is the best, I guess. You can reach me at mbrady@madison1031.com. I spend a lot of my day answering questions about 1031 exchanges. Happy to chat with people about this tax reform stuff as well. I do a lot of talking on it. I've done a lot of, public speaking and podcasts on it, and we're kind of staying on top of it on our end to see how this develops. And yeah, that's really the best place to reach me.
Yeah, Michael has been, for years for me, the go-to guy on discussion for 1031 exchange. And he's been, now he's at Madison and he's doing the work there. I've done a lot of business with Michael in the past. We definitely recommend that you, if you're doing a 1031 exchange, to reach out to him because he definitely is knowledgeable. At least consider him as a resource for you. Stephen, anything else before we let Michael go?
No, Michael, thank you. It'll be an interesting ride the rest of 2021.
Yeah, and I'm happy I decided to continue talking to Eric after Tampa beat the Islanders in the playoffs. But it was good to talk to you guys.
Oh, that was a series. My gosh.
Yeah, I think that was the true Stanley Cup final. It looks like at this point.
And that was Michael Brady from Madison 1031. Stephen, what were your thoughts?
So I think Michael made some excellent points. Our investors, we're just seeing a lot of stress and everybody running around in circles wondering what's going to happen with 1031. 1031's going away. I think that in the end, probably what will happen is just what Michael said. It'll probably go up, maybe to 25%. Everybody wins and the sky won't fall.
And I listen, I hear the other side of the story from this too, is we have to do something about, there's two parts to the government budget equation. There's, revenues and, income, revenues and expenses. And we've been spending like drunken sailors. We got to do something about trying to get control, be a little bit more fiscally responsible. I get it. I understand. But this is not the way to do it. The 1031 is accretive to not only the economy, but to the tax base. And you don't, this is the last thing you want to try to hit. There's so many other ways that you can try to increase revenue and try to balance this budget without making, this is going to take a step back. So it's not really something we want to be targeting here. And I understand also Mike's point about it's fairly unlikely this is going to go through. But the first time we sleep on it as investors, as brokers, as contractors, the first time we sleep on it, that's when they're going to get this thing and they're going to kill it. It comes up every couple of years. So I know it becomes tiresome after a while. I've been sending notices every time this comes up, seems like every 2 to 3 years, but I'm going to do it again. I've already been doing it. Please let your Congress people know what your feelings are about this. And if you're in the investment community, I would believe that you're probably on the side of making sure that this does not go away. Stephen, anything else? How about other shows? Michael's been on the show before. He's been a great guest. How about other guests?
So the place to go is our website, www.investfloridashow.com. You can go back now. We stretch back. How many years is it, Eric? It's like
too many to mention.
Too many. We can't, our memory goes as you get older. But there's a lot of.
I think you died 3 years ago, and you're still doing You're still here doing the presentation. It's been going on for so long.
There's some great information on the shows and great resources, and then also download the app. You can listen while you're mobile or in the gym.
Guys, as always, we appreciate the time that you invest with us each and every episode. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odum and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.